space provided for pictures. Draw those pictures, illustrate them, use colors, guys. Use colors. Like you noted, I always drew absorption, with a dark color. Okay, you're going to see me utilize that throughout the next, 9 sessions. Now note, make these sorts of, graphic depictions for yourself. Again, this is ultimately a template built for you in mind. Okay, now the last thing is how do you actually complete this template? Well, it's very simple. Okay, you must think of the template as a stencil. So you get to the end of the day, you've observed potentially 2 or 3 of the 10 strategies in maybe one market or a couple of markets. You then go back when the market's done, no risk on the table, nothing other than time to do your debriefing, and you go and apply the stencil to the market. So you start off with, like you can see in front of you, they observe the pattern, and you go and observe on strategy 1 that I observed in the oil market. What was it doing? Was it trending or consolidating? Okay, so the template acts as a stencil, and you go and then view in the market what was the fact-based information based on the strategy I'm observing. Okay, now you go through each one of these sections and you draw upon the information that's come from the strategy you've observed. Right, because what's going to happen now in time is that as you begin to observe this same strategy time and time and time again, you're going to notice that the characteristics I've outlined for you are going to keep repeating themselves. Right? Yes, occasionally they are going to be slightly varied, and that's the important nuances to learning these strategies. Because when it varies, the outcome is going to vary as well, and that is the real skill that you're going to develop completing these templates. Okay, now what we're going to do, let's start off with obviously observing the pattern. So again, note the 2 subsections to observing the pattern. First is market context and market conditioning. And when we start off with market context, we talk about whether the market's trending or consolidating. Now, do bear in mind, we spoke about the concept of consolidation versus absorption and auctioning. We spoke about the key difference being the relative volume. Now, note, we also spoke about dark shades with regards to absorption and auctioning, as well as the potential for extension. So obviously, the strategy of absorption and auctioning, we do want to see those dark colors, and we do want to see not necessarily trending, but definitely not consolidation. We want to see some sort of absorption type auctioning price response. Now, in terms of the balanced imbalanced markets, again, what we want to see is we can see the strategy in both. However, we note that it will likely be more aggressive in imbalanced markets. Now, what you would typically do here is you would get your strategy, whether it was, you'd get the absorption auctioning strategy, and you would determine, was it in a balanced situation or was it in an imbalanced situation? And you will then go and fill it out accordingly. Okay, now obviously in terms of trade location, in terms of market context, we do tend to see the strategy work better at extremes. Okay, why? Because obviously at the extremes, once we get that break, just after the absorption at the extreme, once we get that break, we do tend to get follow through as liquidity becomes slightly less on the breakout of previous days' highs and lows. Okay, obviously do bear in mind we do get the absorption auctioning occurring mid-range sometimes. However, by the very nature of it being mid-ranged, the market tends to be quite well balanced. Therefore, it's imperative to note the volumes trading through, as you could well be observing a consolidation period rather than absorption and auctioning. So just bear that in mind. Now, all right, then in terms of market conditioning, obviously we've got our various time frame participants. This is where you'll refer to which time frame participants were in the market. Note, we do have the 3, obviously we've summarized it in 3 time frame participants: large influential time frame participants, as well as algorithmic and speculative in nature. The major difference: large influential can obviously influence price, create initiative, and hold directional moves, whereas speculative and algorithmic, by the given the rules that they do trade by and obviously the strategies they employ, ultimately they tend to not hold on to positions as long, and they're far quicker to unwind those positions as well. So do just always make sure you're referencing which time frame participants are ultimately creating the market condition. In terms of liquidity, note we spoke about the different types of liquidities within both the accumulation and distribution zone. Obviously within the accumulation zone, you're going to see large pockets of liquidity at the extremes, large selling being absorbed at the lows, large buying being absorbed at the highs, and then ultimately the absorption just before the break. And obviously note, once we do get the break, the liquidity or the nature of the liquidity does shift from being provided at the extremes within the auction zone to suddenly then kind of disappearing, and the market looking to navigate toward the next pocket of liquidity. Okay, lastly then, obviously in terms of market conditioning, is volatility. And again, do note we spoke in terms of volatility. We said volatility does not equal trend. Volatility is simply a greater variance around the mean, so a greater number of prices being traded over in the same time period. And obviously we said that volatility will be relatively low within between the two pivots. Once we break out of those pivots, we should see volatility expansion. Okay, so that's how you would look at observing the pattern. You would go through each one of the market context as well as market conditioning, look at the market, draw the facts from the market, and apply yourself accordingly. Okay, good luck. Let's move on to the next session then of the template. All right, now the second part then of the template is all about strategy identification. So in the first, obviously, part of the template, or the beginning process of our template, we draw the picture, we select our strategy, and we observe the conditioning in which we find that strategy. Okay, so we create the market context. Now, what you're going to see as we go through a lot of these strategies is that market context is imperative a lot of the time to the potential reward. You're going to see me refer quite often to having, very, very rarely are any of these strategies going to have an exact target. Okay, trading is not that straightforward, right? We're not algorithms, we're discretionary traders. So a lot of the time our targets are based upon whatever context the market's in. So what I mean by that, for example, let's say obviously markets are trending and we're playing a breakout trade. Now, the potential for reward in a trending market where it's breaking out is much higher than, say, a market that's very well balanced, that's simply just moving sideways. Okay, so a breakout in a balanced market versus a breakout in a market that's trending, you're going to get very different outcomes, and your reward structures are going to be very different. Okay, and that's why we do paint initially the picture of what is the market context. Okay, so you can develop an understanding of what is the best context in which the strategies are working for you. Now, once we've obviously identified that context, we're going to move on to obviously identifying, the strategy. So what are the key observations that say to us, bang, that strategy is in play? All right. What was it that you could outline and draw from the market that said this strategy was in play at this point in time? Okay. Now, you're going to hear me talk quite a lot throughout the next couple of strategies over the next couple of slides. You're going to hear me talk, the next couple of strategies over the next couple of units. You're going to hear me talk a lot about, clues and what is the timing clue and what was the signal that, bang, there was your opportunity to get in with limited risk and maximum reward. And that's pretty much what you want to be identifying as. What are those identifications that you can draw that make the strategy in play? Okay, so the first obviously we talk about is the interaction. Okay, obviously remember the footprint tool is nothing other than an interaction tool. How are the buyers and sellers interacting? And that's what you want to talk about here. Now, what you'll find is with a lot of the answers I've given, particularly as we go through this over the next 10 units, I'm not going to regurgitate and just keep waffling on, etc., etc., because I want you to learn to think for yourself. I'm going to kind of just show you how to do it and give you little ideas of what you want to be thinking and talking about. But ultimately, through practice, you're going to get very good at completing these templates. Now, obviously, in terms of interaction, we first want to think in terms of responsive and initiative. So we spoke a lot about this principle in Unit 3. We touched upon it again in this unit session, and we're going to touch upon this for the next 9 unit sessions. So do note, obviously, whilst we're inside those two pivots, we noted the responsive behavior. So we saw the dark, sort of delta patches at the extremes of the pivot. That was ultimately the responsive, price response. And then once we get the break out of those pivots, that is the initiative break. Okay, then obviously in terms of, is the interaction passive or aggressive? Well, again, note, it's initially quite passive. Why? Because market rotates between the two pivots and there's just passive interaction taking place. eventually that shifts on the break and it turns to a more aggressive price response. Now in the box below, obviously, if there's any kind of variations you want to talk about, any kind of, entry points, any kind of, key points that really reflected time to enter, etc. That's where you want to include it. So in this box, what I would like to include, and what I want you guys to think about is, what was the key observation you took away in terms of interaction that gave you the clue that the break was coming? Okay, now we spoke about absorption just before the break. So for instance, obviously to the break to the upside, we spoke about how before the break we were seeing large selling absorption at the high and large buying absorption at the low. Just before the breakout of the high, we suddenly saw, instead of seeing large selling absorption, we actually saw large buying absorption at the high. And that's what you want to write in that box. What was the interaction that gave you that clue? Okay, because again, by writing this down every single time, you're going to learn to develop pattern recognition ultimately. Okay, now metrics, super important. You want to pay attention to these key metrics. Again, you simply get the chart up, go and have a look at the volume, look at the time, look at the delta, the cumulative delta, and the relative change. Make sure you're writing down what was happening with every one of these metrics within this strategy. Okay, so in general, what we observed was high volume within the distribution, but much higher on the break. For obvious reason, initiative does tend to bring new business and high volume. In terms of time, it is a relatively key proponent, okay, and obviously this depends quite a lot on context. So in an imbalanced market, obviously, when we do get that break, if it's a break of an extreme or maybe the morning session high or low, obviously, we want to see that market continue in the direction of that break, and obviously the longer the market takes to continue in that direction, the more vulnerable it becomes to the opposite direction. Then in terms of delta, obviously you want to talk about what was the delta shading looking like. So go and observe all the dark circles, go and observe all the imbalances, go and observe all the light circles, observe the color shading. Okay, if you do this, I know now it probably seems a little bit difficult, a little bit cumbersome, a little bit like I'm not quite sure what I'm interpreting, but I guarantee you do this for 2-3 weeks and you're really going to start to recognize patterns, where dark shading should be and where it shouldn't be. Okay, obviously then, in terms of the cumulative delta, note we should see no real change to the cumulative delta within the two pivots or between the two pivots. But once we break, we do want to see that delta move in the direction of the break. And lastly then, we want to talk a little bit about the relative shifts, the relative changes, whether that's to price, volume, delta, any kind of, the color changes, whether it's in the summary box at the bottom of the footprint or whether it's on the footprint itself. You want to go and highlight any kind of relative changes that occurred whilst you're observing the strategy. Okay, so that's how you'd identify the pattern. Again, like I said, when we completed the first part of the template, once you complete this part, straight away, after doing this for a week, again, like I said, you've got to have faith that this is a really strong approach, because what you're going to notice after a week is you're going to start to identify strategies, not so much with the picture necessarily, but how they should move. In other words, how should the buyers and sellers interact based on my analysis? How should the metrics interact based on my analysis? Now, what makes this, so brilliant is that you're observing fact-based information. So you're taking the facts from the market to develop your patterns. Now, when those facts repeat themselves, guess what? The pattern's going to repeat itself. And that's what we're after. We're after an objective, fact-based approach to trading strategies. Okay, let's now move then on to the last part of the template, which is the execution methodology. Now this is probably, again, I know all three parts are extremely crucial, okay, but this is probably the part of everyone's template or debrief that gets the least attention. It's quite surprising, because you'd think people would spend the most amount of time, managing through their execution methodology. Now, the reason most people don't spend time is because we kind of just assume that we're always executing in the best way possible, right? Now, I'll tell you why we're never really executing the best way possible, and it's simply got to do with because we can always, get a better price. We can always have a better stop. We can always get more size in. Okay, we can always get our timing even better. So that's the reason why we focus so much attention on our execution methodology. Okay, because we can always improve. Now, The reason this is imperative, and again, it comes down to percentages. Very simply put, if we increase our efficiency of execution by, let's say, a menial number like 10%, just simply by viewing how we're executing, and we increase it by 10%. Let's say you have £100,000 year. Okay, in theory, you should be increasing your profits by 10%. Okay, now a 10% increase in profits, most of you would say if that was a normal business or that was any kind of a venture, the 10% return on your investment, which is i.e. working on this template, working on developing better execution methodology, you would all agree that this is something you would definitely invest in. Okay, so that's the crux of it. That's why we focus on the execution methodology. Now, again, we're going to start off with the two subsections, both money management and the application side. Under the money management, we're going to focus firstly on obviously passive or aggressive. So in this section, all you want to talk about now is that point from you've identified the timing, the market has said to you, bang, it's time for you to be long or short. This is now everything from that point that you click to the point that you get out of the trade. Okay, so the first thing, was your execution methodology passive or aggressive? In other words, on this strategy, do you have to be aggressive in nature, okay, or do you have to be passive? Now, what you're going to find with this is a sort of a double-edged sword, because most of the strategies you'll see predominantly they focus on more passive type approaches. We sort of use signals like absorption, like volatility shifts, so we allow ourselves more passive entries, but sometimes within the same strategy, you're going to have to be a little more aggressive. Okay, so there's, again, like I said, there's no wrong or right. It's important though that you highlight, was, on that execution, was I passive or was I aggressive? Okay, what was the result of you being passive and aggressive? If you were passive, did you miss out on prices? If you were aggressive, could you have got a better price? Those are the kind of things you want to spend time thinking about. Okay, then obviously, in terms of the risk stop placement, again, where did you put your stop? Where was the ideal place to put a stop? Now, what you're going to note over the next 10 strategies is I'm going to give you ideas of where stops should go. Okay, as a cardinal rule, there is no such thing as the right place to put a stop. Okay, please note that. There's, too many people have this understanding that a stop has to go here or there. It doesn't. Okay, a stop goes where a strategy has become invalid. It's as simple as that. So if your strategy is a momentum breakout, we break out, come all the way back in and re-enter the range, guess what? You should be stopped out. Okay, there's no questions asked. There's no where should my stop be. It's as simple as when the strategy is invalid. In other words, it's no longer in play because of what the market's price is doing. You exit, you're gone, you're out. Okay, that's how stops should be managed. Now, obviously note, again, ask yourself the questions. Where was my stop? Was it too tight? Was it too loose? Okay, when you do have winners and you don't get hit on a stop, always ask yourself, could I have tightened that stop a little bit? Right, you always want to be trying to save that tick. Don't forget, one tick on a 10 lot, okay, is €100, $100, whatever it might be. That's a lot of money, guys. You do that over a period of 100 or 1,000 trades over a year, we're talking about $1,000 to $10,000, okay? Just by saving one tick. Again, it's the small increments. This entire course is built up of little edges, little understandings, and it's those little edges that will ultimately give you the big edge, which is ultimately becoming a financial futures trader. Okay, now, in terms of targets, again, there is no exact target for any one of the 10 trade strategies. I'm going to advise you. I'm going to kind of tell you where the pattern has kind of exhausted itself, or the pattern is potentially done. And I'm going to give you advice where potentially targets will go. But again, you have to work on this, because what I deem as a potential target might not be the same for you. Okay, and that's important, and that's why we work on it. And then obviously risk reward, again, I've put it there, not so much as it needs to be focused on, but I've put it there so that you can recognize when trade strategies are no longer becoming worth the risk. Okay, so again, by following a metric like risk reward, you're going to recognize if you're used to taking maybe 2-to-1 risk reward on a trade, and all of a sudden over the last couple of weeks, you've recognized this trade strategy is suddenly offering 4-to-1, or maybe it's offering less than 1-to-1. Okay, that's the kind of things you're going to pick up on, and that's when you as a trader have to be flexible and nimble to adjust yourself. Maybe change strategies, maybe change your approach. And that's the purpose of completing these money management metrics. Okay, then obviously, in terms of obviously the strategy, do note We spoke about obviously a passive retest in terms of entry point on the absorption auction. So we wait for the pivots to break and wait for a retest and enter. We had a relatively tight stop, as mentioned, just below, back inside the distribution. Obviously, we take profit when the market gives us that reason to exit. And like with every one of these strategies, with very limited risk, ultimately we've got really good risk-reward metrics. Okay, once you've focused on the money management side, you then move on to the application side. Okay, and this is crucial. Now, application is all about how do you execute. Okay, and this comes down to, again, a little bit more of the psychological aspect of execution. But the first thing you want to talk about is your timing. Okay, what you're going to find is you're going to battle with this concept of, should I be stubborn and wait for the exact price, or should I be willing to ultimately, be more aggressive and preempt the trade strategy? Okay, sometimes it will pay to be aggressive, and sometimes it will pay to be exact. What I am going to say to you, play around with the two. Okay, don't take my word as gold. Make sure you're playing around with it to see what works better for you. Okay, some traders are better at naturally being more aggressive in execution. Some aren't as good. Okay, so work within your own confines of your own characteristics. That's how you're going to adopt these strategies in a much better way. Okay, do note, as a rule of thumb, when it comes to preempting, remember this. It is okay to preempt only if the preempting gives you very, very good risk reward. In other words, and we'll talk about this in one of the later strategies of breakouts, breakouts reward preempting. Why? Because the nature of the break will bring in a great deal of volatility. So we cannot afford to miss out on all that potential reward when we can take just a little bit of risk to be a part of that reward. Okay, so as a rule of thumb, if there's very good reward, don't be afraid to preempt, okay, because you're getting paid for that additional risk. Equally, in terms of targets, in terms of reward, remember, as a rule of thumb, the more a market moves in the direction of your favor, okay, and you're going further and further on sides, the more you potentially have to lose. Okay, so that's a really important thing to understand, because the more you're going on sides, the bigger effectively your stop is becoming. Okay, and equally, the more you go on sides, the smaller the probability of further profit there is. And that's important to understand. Okay, so the further you go inside, don't forget, you can never go bankrupt taking profits, right? But you don't want to allow yourself to become greedy, to become too specific in target taking, that you ultimately start seeing your winners evaporate. Okay, in terms of leveraging, then we're going to talk a lot about this. This is just simply, can you get big? How can you get big? Can you put on some size? Where can you put on some size? Where can you get big? We will discuss leveraging a lot later on in one of the units and why it's so important. But for now, just know, within this strategy, we're not interested in leveraging. Why? It skews the risk reward. So again, when you go through your strategies and you come to the section on leveraging, ask yourself, could I have got more size? Where could I have got more size on? And how could I have got more size on without taking on more risk? Okay, we finished every one of these every one of these template completions with the tip. Okay, again, these are my tips. They could be your tips. It's up to you. So the tip for the strategy, obviously, usually a calm before the initiative is taken. And we spoke about that. I showed you what that looks like. It's a little bit of absorption just before the break. And do note, volatility breeds volatility. Okay, what you would then do, this is not the end of the template, obviously. There's two more sections to the template. One is the accountability section. You write down how long it took. How long did it take you to complete this template? Reason being, obviously, you'll get better, you'll get quicker. It's also a way to motivate yourself to see it actually doesn't take that long and you're gaining quite a lot from the experience. Also, don't forget to sign off on it. Equally, don't forget to fill out which day it is that you're completing this on, simply so you can follow yourself building a habit. Okay, building habits, the first thing you need to believe is that it can be done within a very short space of time, and that's why we have that day count at the bottom of the template. Lastly, read the quote. Keep reading that quote. Keep reminding yourself why it is you're filling out this template, and remember, you are on a path to sustainable pattern recognition. Let's move on then to the following slide. So like I mentioned earlier on in the unit, every one of the trade strategies is going to include an additional reading, and for very good reason. These are books that often I get people asking me, what books would I recommend people read? Now, I don't believe in necessarily reading trading-based books, simply because they tend to be very backdated pieces of information. So they don't really help in the modern day market. So for me, I far rather pay my attention to real thought-provoking type books, principle-based books, process type books that can help me become a more effective trading athlete. Now, the first book we're going to recommend, or I'm going to recommend, is Ray Dalio's new book, Principles. Okay, this was released, I think, in October, November 2017, so it's just come out. A little bit about Ray Dalio. Most of you should have heard of him. He is effectively the founder of Bridgewater, and it is one of the largest, if not the largest, hedge funds in the world. So again, there has been a number of videos you can go watch on YouTube, but you can go watch, you can also go read one of his documents about Principles. And Ray Dalio deals with all these concepts of doing things differently, trying new things to ultimately get the most effective outcomes. Now, this book is no different in terms of a summary. It's a real practical application book, hence I'm recommending it. In terms of the action, it's going to provoke your thought for a definite, but it's also going to make you want to start to implement actionable processes, and that's why I'm really excited to introduce this book to you. Now, some of the key highlights, I don't want to spoil it too much, but there is a 5-step process for getting what you want out of life from this book. Becoming open-minded and learning from your failures and weaknesses, a concept we're going to deal with a lot throughout all of these strategies. You're often going to hear me talk about how through me failing at certain strategies, ultimately I learned a new strategy. Then moving past your ego so that you can focus on the pursuit of your goals, as well as why having people around you is important for increasing probabilities. And lastly, the idea of meritocracy and the best ideas through disagreement. And this is a fascinating concept, because what it ultimately says is that through disagreement, the whole idea of brainstorming effectively is not as effective as people think, but rather disagreeing with people is the best way to ultimately get some of the best ideas. So definitely read this book, put it on your wish list, make sure you get this, and read it as soon as you can. All right, let's now finish off and talk about some of the drills for the rest of the unit. Okay, so at the end of every unit, we're going to have a live drill practice session. And basically this is for me to introduce the drill to you, give you an understanding of how to execute the drill, as well as the process thereafter. So it's simple. At the end of every unit, you are going to find a drill. I suggest you go watch the drill with key focus on the interaction and relative changes. Okay, so go through again the principles underlying the strategy, read through that first. Once you've read through that, watch through the entire drill session. Now, once you've watched through it, go and complete the template. Okay, that's so important. Before you go on to the narrated drill session, make sure you complete the template yourself. Okay, the reason is that you're going to learn a lot more through your mistakes, but more importantly, you're also going to remember those mistakes a lot better, rather than going straight to the guided tuition. Okay, once you've done that and you've completed the template, go and watch it with the guided tuition. Compare and adjust your template. Okay, so make the necessary changes. Remember, there is no right or wrong. Okay, add to your template where maybe you might not have thought of something. Okay, then I suggest you go back and watch the full practical examples utilized within the unit, and again, focus on some of the key principles and focus on obviously the identifiers within each one of the template sections. Okay, again, complete a second template. This is for your own good. Lots of practice will get you good at completing this template. And once you've done that and you have confidence in the strategy and in the principles underlying that strategy, move on to the next unit. All right, that now wraps up Unit 6, Strategy 1. And we're going to finish off with the quote, which is that success is the sum of small efforts, repeated day in and day out.
So welcome to this drill session. This is Strategy 1 Guided Tuition. So let's get straight into it then. Let's roll the tapes forward and let's talk through as we go through this entire video session. Now, the market we're looking at, this is the WTI oil, and in terms of the context, or what we can see is we have got ourselves some rotations here, some 5-minute rotations. In terms of obviously the type of footprint, it's a time-based footprint, and in terms of the context that we find ourselves, well, the first key standout is the very negative delta on the day. We can see that down below, minus 5,190 at current time. So we can see quite an aggressive short positioning in the market. And we can see that really over the course of the session, we can see the sellers have dominated for pretty much the entire session. Now, very important, as we can see as per the candlestick chart, we can see price is responding to that dominant price action from the sellers. In terms of the current footprint, just a quick note here. Do note the imbalance sitting in the middle there. Again, what we do tend to see in the strategy called accumulation and distribution, absorption and auctioning, we do tend to see these imbalances whilst we are forming that sideways price response. Now, to cast your mind back in terms of the strategy, the key elements of the strategy, or the two variations at least, is this sideways type price response, but what we're ultimately looking for in essence is some form of a darker shading at the extremes, and that's kind of what we can see already. If we start on this left rotation here, note the dark extreme shading. So what in essence we are seeing there is sellers come down to that price point, and they're selling, but they're being met by a buyer that's absorbing all of the potential liquidity being sold. Okay, so at the low there we have got a buyer taking all the liquidity. The market then bounces and we go to the extreme side, and at the extreme sides we can see the same thing, darker shading. This time however, on the top side, it's the seller that's taking all of the liquidity. Now, one thing I will say, always look, and again, a lot of the time it might just be, complete noise, but always look where the heavier liquidity is being taken. So what we can see at the low extreme here, note 600 lots by 223, 561 by 556, 616 by 445, 541 by 433. So we can see quite a lot of the volume being taken at this low relative to this high. Okay, so what we're seeing on the high here, whilst there is still a pickup in volume in the darker shade, what we're seeing is we're actually seeing a lot less overall volume at the extreme. And what that's telling us is that the sellers are being more aggressive at the low here and more intentional at the low versus what the buyers are being at the high. So always interpret the total amount of volume being transacted. Now, what is very interesting and what's important to note is we do have the inside candle. So we can see this is variation number 2 of the strategy. We've got this inside candle now. It's formed inside of the previous candle. Do note what we're seeing at the extremes. Okay, 41 by 10, 0 by 30, 0 by 17. Okay, so this is telling us there is a real reluctance to initiate above this price point 16. Okay, we can see it not just once, not just twice, but now a third time buyers are not willing to initiate above price point 56.16. Okay, the same can sort of be said for the downside. We can see sellers did not want to initiate below this 56.01. Why? Because we can see only 43 contracts traded there. On 56.05, 92 by 46, and now again at the 06s, 70 by 0. So there's a real reluctance at the extreme points to be initiating. Okay, and what we're seeing at the extreme points is actually passive responsive liquidity being utilized. So yeah, we can see the buyers utilizing the sellers, and at the high we can see obviously the sellers utilizing the buying being provided. Okay, so that's where we are. That kind of brings it all into context. Now, with the strategy, so important. Okay, obviously we spoke about that signal, that clue when the market is about to break. So we're looking for that. We're looking for something that shifts, something that relatively changes, and that market kicks it up a gear. Okay. So what we're doing is we're looking now for the clue. We're looking for something that tells us that, you know, the nature of the market has shifted, and we've seen quite an aggressive change in the dynamics of the market. So that's what we're trying to keep our eye out for now, is some sort of a shift that gives us that clue. Now, keep in mind, obviously, one of those clues could be the break on either side of this, i.e. suddenly we see initiative above 16s or we see initiative below 06s. Equally, we could be looking for some seriously aggressive absorption on the extreme. So instead of the sellers taking all the buying at the high, we suddenly start to see the buyers absorbing at the high and vice versa, sellers absorbing at the low. That could be a second potential clue. A third potential clue could be a sudden shift in the price dynamics. Okay, so those are the kinds of clues we're looking out for. Now, do bear in mind, obviously, we always want to potentially go with the trend in terms of context. We've observed the trend is to the downside. We can see that with the cumulative delta. And note, we can see relatively subdued volume at the moment. Obviously, we had the 10,000 rotation, and then we had 5,000 and 3,000 rotation. So let's have a look now. Let's talk this through. So we can see markets come back down again towards that 06 area where it will not initiate below. We can see again still relatively subdued price response, no real shift in the dynamics, but this is now obviously the fourth rotation within the previous three rotations. So we can see this elastic is coiling and coiling and coiling quite aggressively, and that's the real key. Okay. Okay, so suddenly there, note a little bit of an imbalance there. Okay, I'm just going to pause that slowly. Note the imbalance, so we can see obviously markets come back down. Suddenly we've obviously seen a seller hit into the 8s and quite a thinning out of trade. Now what we want to see if this is going to follow through. Okay, this is the first time we've seen this. We've seen a little bit of a shift in the dynamic, and note straight away 122 at the 6s. Note the sellers are now becoming more intentional at that price where they would not become intentional previously. We can see 136 traded. At the same time, we can see someone buying, but what happens? We see the selling, and that's our signal right there. We could see our sellers stepping it up, becoming more intentional at those 6s, willing to be initiating at that low. We're now looking for an entry point where that seller stepped in 05, 06. We're trying to offer the 6s here, trying to get filled. We can see 3 contracts traded, and there we should be filled now. Another 50 trades at 06. Our stop simply goes above the 11s, above the rotation. Obviously, we have to protect ourselves in case this fails. But ultimately now, note where the absorption is taking place. Notice where the market's holding. Okay, it's come back up to those 6s and 7s where we saw that shift in dynamic, and the market is now holding. Okay, note the absorption from the sellers. So we can see sellers stepping it up here, holding this price point, and bang, 6s trade, 5s trade, quite a bit of volume going through now. If we look at the delta, note the delta shift. Okay, minus 550. The last time we had quite an aggressive shift in the delta was the downward rotation before settling into sideways mode. So we really can see those sellers now stepping it up, really making an initiative move here, looking for a potential distribution or continuation in the direction of the break. Okay, so this is obviously our this is now the move that we are looking for, and ultimately, okay. So again, we come back up to those 6s, 7s, and we can see the market holding, and again trying out those 7s, 8s, 9s. So really testing our stop, but we've got to stick to that stop now. We can see that the sellers are happy to get hit on any kind of buying here. And again, we go 10 offered down to 9, down to 8, 7 and 6 and 5 and 4 and the market starts to pick up again where it left off. Note the delta now the most negative it's been on this rotation. We can see the delta at the bottom, also the most negative on the day, and bang, note the imbalances. Okay, lots of zeros going through, a bit of stops going through, one order stopping down. We can see the aggressive nature of the price response also shifting. Cumulative delta negative 7,400, nice big fat imbalance or low volume area, all the way from 05s down to 96s, and we can see a little bit of liquidity being provided at the low here. And again, this is normal. Okay, you're always going to find pockets of liquidity being provided. The question is how much more selling has to be done. Okay, if there's more selling to be done, we will obviously continue in the direction of the break. Now note the volume. Okay, a very, very big shift in volume. That's why it's gone dark blue in terms of the volume traded. We can also see that delta going very, very dark red. So really aggressive intent coming in from the sellers. They have taken the initiative and the break has occurred. Okay, so just to recap in terms of that entry point, okay, it wasn't as aggressive an entry point or a signal as you can get. All right, you can get far more aggressive ones. However, we were aware of it. We observed the nature and dynamic of the market. We observed the context of the market. We saw the inside candles forming, and we know it's one of our variations. We then, finally got an entry around that sevens. 5607 with a stop at 5612, good 5-tick stop. In terms of target, okay, we're still in this, right? We remain in this until the market gives us a reason to get out. Now, obviously, we can see that that low volume area and that imbalance area. So long as this holds, we will remain in the trade. We will talk about that trade strategy later on in the session. Okay, guys, hope you enjoyed that. That is then the first of our drill sessions.